Thank you, Steve. Thank you, everyone. And thank you, Vince. I'm now going to make you the presenter. Looking forward to having a conversation with you. Waiting to see your screen, hear your voice. Beautiful. Even a webcam.
Right. Do you hear me?
I hear you. We see you. We got your setup. Vince, very nice to meet you. I think it's kind of a funny story how we met on Twitter. We had like a little Twitter misunderstanding, right?
Well, misunderstanding. You're being a gentleman. I was being
Anyway, so that happens on Twitter. You know, I told you on Twitter, it reminds me of when I was in elementary school, and the guy you'd get in a fight with on the playground ended up being your best friend. So maybe we're going to have the same outcome here, buddy. So
I think odds are yes.
All right, I like it, and no stop on this one. So I know you've been around a long time. No one's been around longer than me. You know, I learned. Yeah, well, I remember having lunch with W.G. Gann and R.N. Elliott in the 30s, and that's where I learned how to trade. Why don't you tell us, buddy, how it started for you, Vince, and
sure,
the long and winding road.
I want to make sure. Yeah, I'd love to do that. Thank you for that, giving me an opportunity to do that. Just whatever you see on my screen, I'm not sure what you see, but the only thing that I have here in the lower left-hand corner is that's for annotation. I'm not broadcasting anywhere. That's so I can draw if you need that to be done, if you have any questions or things about that. And I have a camera on in the lower right-hand corner.
Right, correct.
I would prefer to see you. If that can happen, you want me to close the camera down for screen space?
Yeah, go ahead and do that.
Okay, we'll do that.
And then you'll see your own screen. And yes, we have the dollar index up there and the silver.
Right, that's what we have up there. I also have just so whatever you want to talk to after I give a brief background. I have some charts on gold from a macro point of view. I'm not anti-technical analysis, but I certainly am not a huge fan of it. But I have to deal with it. But to your question, my start in the industry was I worked at Lehman Brothers as a copy boy for Martin Shafroff, a managing director, and I was a fundamental analyst. And the guy I worked for, CFA, would make me call chief financial officers and get all this fundamental information. And one day I asked him a question about options, and he said, "Options? Those are voodoo magic. We don't deal with those." And it turns out they were statistics, which was my education. And I ended up moving from New York back to Philadelphia and took a job with Cooper Neff, who promptly shipped me back to New York. Anyway, I got my training and skill set in options market making and volatility assessments, and have traded every commodity in New York and some equities. And then from there, I left and started my own firm, started trading out of funds, and precious metals and energy are the commodities that I'm most intimate with on a physical macro basis. But volatility is my thing. And frankly, I'm excited to be here because you do a lot of Forex. I think Forex is underutilized as a trading tool, and whatever you'd like to speak about, whether it be.
Yeah, you know, it's the deepest market out there, Vince, right? I mean, the deepest market is currencies, and inside you could fit global bond markets, and then inside that you could fit in stock and commodity markets. So, you know, to me, it's kind of like the linchpin that everything spins around.
Right. If people, I think, would understand that, would think of it this way, that first of all, acknowledging the size of the markets. These are trillion-dollar markets. Liquidity is not an issue. They're more continuous in their movement. They jump less as opposed to stocks that gap higher, number one. Number two, they're deeper, as you said. Number three, a currency really is, when it comes down to it, the stock price of a country. And the fourth reason is the reason that I like them. I like trading currency pairs because they have less noise. People who trade price based on price, they have to deal with noise. How much is noise? How much is not? FX markets have less noise. If one pair is doing one thing, another pair will do another thing, and you can play with that. I like to trade volatility because it's less noise in the signal. I like to trade FX pairs because it has less noise in the signal. Gold is a currency, not a currency. It's money it's a proxy for the dollar. But gold has a lot more noise in it than, say, dollar yen or even dollar yuan these days.
Okay, interesting. While we're there, do you have an explanation? How people use typical correlations of weak dollar, strong gold, strong dollar, weak gold. And we've had a relatively strong dollar for this whole advance in gold from 1160 to 1350-ish. It certainly hasn't been dollar driven. To me, it looks like it's going up against all fiat. Is that what you're noticing, or how do you explain gold being able to perform during a steady dollar period?
Okay, there are, so I put gold up there on the right for you. There are several factors affecting gold, and I'll categorize them simply as the correlation with the dollar. It's priced in dollars, so the stronger the dollar is, the lower gold goes, and vice versa. That's very important over the long term. The reason that you would own gold is as a hedge for a debased currency. Second is mechanical. Mechanical meaning if someone has to do an irrational sale, like Venezuela, which we can touch on if you want, that would distort the market's relationship with the dollar as someone is forced to sell or someone is forced to buy. Long-term capital management, they were forced to buy. That distorted the relationship. So these are correlations.
How about the low being made at 1160? There was talk out since Erdogan did not want to play with interest rates that was it could have been what you'd label as an irrational sale from Turkey's central bank when we went to 1160. What do you think?
Okay, I think that's actually although I don't know what the country was.
Yeah.
Actually, put this up on a weekly because I think your point is incredibly valid. The gold market, and I'm going to tie a couple macro points together because it shows cleanly on the weekly to your point about this low here. Okay, this is cash gold. So it's around this time, right, when the market started selling off, and this happened at the same time the trade war started. This also happened, believe it or not, when Venezuela first said they were selling their gold. They had gold to sell, some gold, for example, and this will tie this to emerging markets in Turkey. It's very important.
Cool. All right.
Go ahead, I'm sorry.
No, all right. It's great stuff.
I want to bring it all together because
you're a holistic guy.
Emerging markets is key here, okay? First of all, this sell-off in gold is irrational to the dollar. And this sell-off in gold coincided with Venezuela selling, some emerging markets selling gold, and in general, that was all a function of QT kicking in. Quantitative tightening, right, is basically the inverse of quantitative easing, and in that relationship, the market has less dollars, right? So I'm Turkey. I have less dollars to pay my loans to the U.S. because the dollars are being taken off the market. So what do? I liquidate what I can get dollars for because I have debts in dollars. And this is emerging markets and Venezuela selling. And your comment about the bottom may or may not be true, but I'm almost sure of this. Whoever was handling this order, all right, this wasn't Turkey or Venezuela selling directly. They're selling and keeping it orderly. And this, what we all know, is beating the VWAP. The last sales, I'm a bullion dealer, not to be too paranoid, okay? If I'm a bullion dealer, I'm selling the market for a client, whether it be a country or a corporation, and actually Goldcorp was selling here too. And then near the bottom, right, your last few thousand lots get sold a little bit sloppily because you may be short as well. Not to be accusatory, but that's what happens when you are a principal in an agency. So to your point about to bring it all together, the correlation with the dollar is important, is very important, and will remain the most important thing long term. The market will be strong with the dollar, during times of crisis, like Brexit or a war, and gold will drop when the dollar is weaker because of liquidation and other reasons. But the bottom line is there are irrational buyers and irrational sellers of gold that distort the relationship. And the final thing is, the less currencies there are in the world, remember there used to be a whole bunch of European currencies, the less alternatives there are to hedge. And so gold has appreciated against every G7 currency over the last 10 years. And the dollar is actually the weakest it's advanced against. I hope that answers your question.
Yeah, and it was excellent explanation. So then we have to attribute this rally in gold, that QT, which was a major factor,
Right.
and even though gold started up before this in a divorced manner from the dollar, as you said, it could happen. So, there's no, correlations are good till they work, or they have multiple correlations that work at different times.
Right.
So your assumption now would be that the Fed is done, maybe with rates, but do you think they're done with QT, which I think is even more draconian than raising Fed funds a quarter point?
Well, I think, to your point about this recent rally, I think there were several factors driving it, and not the least of which is what you said. The perception that trade wars were going to be resolved really have not had an effect on this. People will look at this, and I can show you information both ways. The problem with China are not it. But I will give you, I'd say, 3 reasons for the market rallying. One is relationship with the dollar, which is not as strong as normal. The second one, is the QT effect backing off. And the third one, I think, is frankly what's coming next, which would be they're calling modern monetary theory, or Q, or whatever, QE infinity. So to answer your question in those 3 parts very quickly, this here, part of this rally is basically the correction back to where it should be with the dollar. So that's the irrational seller being done. And now you have commercials covering and shorts covering and et cetera, et cetera.
Okay, so, there were record short positions on the COT going into that low. But, if you just went when it was record positions, you were $50 early. So you bring up commercials and the COT.
Yes.
So people have to realize, tell me if you agree with me, that commercials have deeper pockets than most of us.
Yeah,
and they can afford to be early, right?
That is absolutely true. And in fact, you bring up a good point. The COT this time was so distorted that you would have lost $50 before you were right. It kind of goes like this. In the markets, especially in the gold market, the strong players are the commercials. Now, commercials are bullion banks and dealers and producers. Some producers will sell directly, not many. Most will go through a bullion dealer who can give them one price liquidity, and then they'll sell it into the market. The flip side of that are end users. If you're looking at the industrial side, end users are jewelers and they buy. Very fragmented, not very unified, not very strong in their buying consortium. Who fills the gap between the selling and the buying are the speculative funds, which are by and large long players. So to your point, and something that's been known for years for anyone who gets in the way of a commercial who's selling, the commercials borrow from the Fed at 2%. You borrow off your Visa at 20% if you're a hedge fund, and they have deeper pockets and can stay a little bit longer. Not only that, they have the advantage of having natural sellers, producers coming into the market on a daily, weekly, monthly basis. So the reason the bottom was so interesting here is because, to your point, it was so stretched that the commercials were actually long in silver. They were long in platinum, and they may have actually had a moment there where they were long in gold, which is unheard of. That's how stretched it was, and yet the market kept going down. Usually it turns on a dime when you have the commercials.
Asia session, Vince. It's interesting. You had a tweet yesterday, and it looks like your work kind of portended a little bit of a pullback and a pause in the move in the gold market and silver market. So, we've talked about the history. I guess people want to know what to do now. Let's just say we're flat gold. We have no position. What would be your outlook? I'm assuming it would, maybe I shouldn't. Longer term, be looking to buy weakness. Shorter term, are you looking to scalp this from the short side? And what levels do you think would be a great entry, say, down the road, if we're not running away from there?
If it's okay with you, I prepared a couple pictures to make this go smoother from macro to micro. Sure. I think your audience would be interested. Is that okay?
Yeah.
Okay. It would be hopefully if I can do this right. I'm low tech here, so hopefully I can.
Yeah, you got it. You have the gold CFD and you have red arrows on the bottom.
Okay, so I want to start with, before I get into what I do, I want to start with what other people are doing. And that is, this is a monthly spot gold chart. So we're starting macro here. The two lines are lines that I've drawn, but coincidentally, Jeff Gunlock, who plays gold, has also drawn. All right, and people have drawn a line from the top down. But I want to focus on the blue line. The blue line is a 12-month moving average.
Why did you choose that?
Well,
I wish monthly.
I chose. Well, actually, I saw some analytical work done on this, and I paid attention to, of all people, Jeff Gunlock, because he he's better at giving clues as to his position as opposed to just talking his position. And I noticed that, well, first of all, the back testing showed me that now this is risky stuff, but it's macro. If you buy gold on a settlement, a monthly settlement above the blue line, you will have an average monthly rate of return of 3.5%. If you hold gold, and let's say you're not a short player, but I play short as well, your average monthly loss below that line, the first month below, is 1.25%. And I have the data going back on this in other charts. So I looked at that and I saw, and I refined it a little bit, and that's something I saw somewhere. I won't bore you with how I refine it, but it is a 12-month simple moving average. And for me, that's the holy grail or the kiddish cup, depending on how you look at things. And I tied this to Gunlock because when we broke through up here on the way down, he said, gold is overbought. I'm not going to look to buy it in 1200 area. And lo and behold, and he had done this before when I had seen these other things. So basically, this is a macro way to look at it. If you're a buy and hold or sell and short gold, it's a monthly. It can be painful to not look at it every day. It's not an active trader thing, and these are the trend lines. Yeah. So the macro on gold basically right now is this: if we settle above 1267 on the month, which it looks like we're going to, you remain bullish gold. If you look at the side of the lines there, you can see that the market has pierced her. Now it's faked me out before. That's one macro thing. The second macro thing, well, that's an explanation. This I think is that's micro. Let me go back. The chat is hiding. This is what we want. We want this. Not this. This. Okay.
Okay, yields.
All right. So this is, I'll try and make it a little bit bigger. This chart, I've been looking for a very good correlation with gold for some time, and I think I've found it. Other people have found it too. The blue histogram with the white line is the amount of negative interest rate bearing bonds outstanding, and that number is 9 trillion. The yellow line is the price of gold. I contend that the more negative interest rate bonds that are issued, the higher gold will go. And and we can get into why, but I don't want to go down a rabbit hole with you, but it's very simply this. It's no
opportunity cost.
Well, it's
no opportunity cost to own it, right?
Well, that is the cost of carry, the opportunity cost of owning gold. That's definitely a factor. But I'm going to tie it even closer to central banks. During this time period here, okay, central banks have been buying more than they have in the last 5 years. And the price of gold has gone up. I'm a central banker. I'm a smart central banker, let's say. I'm using QE. So I'm printing euros, okay, and then I'm buying my own bonds in the market so hard that I'm making them a negative interest rate. And that's to get people to put their money in the stocks and hopefully boost the economy. But at the same time, although I won't admit it, I'm worried about the fragility of my currency. And so I also buy gold as a hedge. That's conjecture, but it's increasingly being backed up. The more negative interest rate bearing bonds there are in total in the market, the higher gold goes. So that's a strong correlation, I feel.
Well, you know what? Then let's talk about where they went negative, and that was Europe. Okay, so I think, you know, there's a lot of confusion on the euro right here, Vince. Are we going to have parity again? Are we going to bounce back to 120? So to me, it's like ground zero for gold and more negative yielding bonds is Europe. Will the direction of the euro be the tip off of Europe going to negative rates again?
Let me put up my currencies because we're going to start discussing that. Sorry about the change, but let me put up the currencies again. We have, let's see, let's put the euro up, right? And then over here we'll put up the yen, right? Because that'll come into the conversation, I'm sure. Okay, the Europe has a problem that's been going on forever, but they continue to survive. And that is you have a unified monetary policy, macro to micro. You have a unified monetary policy where if Germany lowers rates, everyone has to lower rates within a range. But you don't have unified fiscal policy. So if there's an earthquake in Italy, you can't tax Germans to bring money there. So I believe that the euro is destined to fail. Not tomorrow, not next week, I don't know. But this is all a product of well-meaning globalist academic dogma, trying to create a unified Europe because they have this history, this scar of World War II, and nationalism really is a problem for them. But to answer your question about gold, I think, well, we know that China is buying. We know that Russia is buying gold. Europe is buying gold too, and I think it's the Germans. Eastern Europe is buying gold because of trade purposes, and the euro is the canary in the coal mine going forward. If Great Britain does pull out, you could see more buying of gold. If Great Britain stays, you could see more buying of gold. But I believe the euro is going to continue to get weaker because of our QT policy, to your point. They are issuing the most negative interest rate bearing bonds. The proof of that is you have the Swiss National Bank buying U.S. stocks. Where else are they going to put their money? There's everything's negative yielding.
Interesting. Okay, so negative euro and great analysis, lower euro. So you're in the camp that strong dollar is going to continue, and strong gold.
That's yes.
Okay.
But I want to put a little timing on it, if it's okay with you, so I don't sound like I'm contradicting myself. All right. For whatever reason, I believe QT is not done. And QT would be the raising of interest rates, right? Like you said, it's worse than just raising interest rates. The raising of interest rates and the simultaneous issuing of debt or letting debt roll off. Now, what that does, if it's done properly, meaning if our government, if our Fed handles it properly, is it strangles the rest of the world to scramble for dollars. To take it to an extreme, let's say there's one bond left in the world, right? And there's $1 left in the world. As they're taking all the dollars off the market, that dollar becomes a deflationary problem for the rest of the world. So I'm Turkey, and I have debts denominated in dollars. and there are less dollars out there. So I have to debase my currency to get more dollars into my country so I can pay my debts back to the US. QT, one of the side effects of QT is we are exporting deflation or lack of liquidity to dollar-based debt, and that will drive all currencies down as people buy dollars. When the world, and now we're getting to when gold rallies hard, when the world is long dollars, if you look at the emerging markets as the poor man holding the bag, when the world is long dollars and China is out of it has de-dollarized its risk enough, you're going to see NERP in the US, you're going to see QE4, you're going to see helicopter money, and it's probably going to be triggered by an S&P print of 2000 or something like that. And then, right, and I truly believe this, I understand this enough, then you're going to see the Fed or whatever they're doing have to do those things, trigger that, and you're going to see stocks explode. Don't get me wrong, as the dollar collapses and gold and precious metals and real assets start to increase.
Okay, so you know what? It's not far-fetched, because look at the crisis we've had in every country that's had a currency crisis. And their stock markets have exploded. You go, well, God, I mean, people are on the street starving in Brazil, and you know, the Bovespa was one of the biggest gainers last year, I believe.
Exactly. And remember in Brexit 2016, after the Brexit vote, the UK, the FTSE outperformed every other stock market.
Yeah.
The booby prize for having the weakest currency in the world that year. Right?
Yeah.
So mechanically, I think people who aren't familiar with how the Fed works, it's kind of like this. Savers have been punished. Savers have been punished, meaning interest rates are low, and so you put your money in stocks, and so and that's fine. Whatever works, I'm not judging it.
Yeah.
But the flip side of it is this. Once inflation gets started, if inflation is 5%, I'll make a number up. Interest rates are not going to 6%. They're going to 4%. They're going to consistently lag behind, so real rates remain negative. And why are they doing that? Because they don't want the stock market to collapse. As long as real rates remain negative, then that 4% CD that our grandmother has is not going to be able to pay for the 5% increase in bread.
Right, because the stock market is their cash receipt machine.
Exactly. The stock market is our currency right now. And here's the deal. Yeah. The unintended consequence is physical assets will go up again. Gold will go up. It'll have to happen. And you know, I did a report on that recently, and I can throw the slide up if you want, if we have the time, or I can go into short-term trading, which I think you also may want to talk about.
Well, you know, we're kind of near the end, but you know, what I look at here, Vince, and we could, the best combination. So when this happens, gold will go up, stocks will rocket. Makes me think gold stocks are really going to be the place to be, because you won't have the negative effect of a weak stock market, and you're going to have higher gold prices plus a higher stock market. What do you think?
That is the fly in the ointment for me. As historically, I'm a fundamental analyst, but the gold companies, let me get my opinion out of the way. Gold companies are managed in general, but the consolidation within the gold industry that's happening now augurs for higher prices, at least at first. So are there undervalued gold stocks out there? Yes, and I'm very familiar with who they are. Are there very poorly managed gold companies out there? Yes. I would love to see the GDX outpace gold in a rally, but I want to caution people who buy gold stocks. There are three types of leverage that a gold company has available to it. It's very simple and it's very important. There's financial leverage. They borrow money to mine their gold. So financial leverage makes you outperform the gold market in both directions. There's operating leverage, which means for minimal incremental cost increase, they can pull more gold out of the ground when the price goes up. That's generally one-way positive. So if you're a big company, you use operating leverage. You don't have to put another tractor on to dig up the dirt. It's already there, and all you have to do is just dig faster, your variable cost. And the third thing is this, and this is the one that should not happen but does. You have flat price leverage. these companies that have operating or financial leverage should be hedging in the market, and they do not. And this is a double-edged sword, and I'm telling you that this is why you would be buying of these stocks. Because they don't hedge properly, in my opinion. Goldcorp was a big example of that recently. Because they don't hedge properly, because executives' pay is tied to stock prices, they end up running their companies not as ongoing concerns, but as hedge funds that want to participate even more with the movement of the stock, of the price of gold. So on the way up, they should way overperform the price of gold, 1.5 to 2.5 times, depending on what's happening. The problem is, how are they doing on cash? Because frequently they hedge themselves on the lows. I'll take you back to 1997 in silver. I'll take you back to 1999 in gold Ashanti. So
Yeah. Okay.
management is key when you're picking gold companies, on top of the fact that you have to pick the sector that you like best, juniors versus majors. I hope that helps.
Okay. I'm telling you, you helped in so many ways today, Vince. I mean, this was such a great interview. I hope that when I invite you back, you come. What I'd like to know now is, everyone's stuck around to hear you today. What's the best way for people to follow you besides Twitter? And do you have any type of business model that you want our viewers that are seeing us live and later the video to know about?
That's very gracious, considering I abused you, or tried to abuse you, but you're the best counterpuncher in the industry. Let's put it that way.
Thank you, bro.
I own a company called Echo Bay Partners. I manage family money. I'm not plugging anything right now, but I'm going to let people contact me through Twitter. I've managed family money, and I have a very good track record. Actually, more in energy than precious metals, believe it or not. But to answer your question directly, echobay.com is my website. That's not a site for conversation. You're better off, if you don't mind, I'm going to put this on the screen.
No, go ahead.
I do want to talk about, I know we can't talk about it today for time, but if you want to contact me, please contact me at Lanci Pictures, CC Dale, and then I'll follow you back, and we can have a DM conversation, and we can talk more. And I would love to talk Forex as it relates to gold, because gold is the tail for that. That's the way to contact me. I will be starting a directional fund. I'm not looking to raise money. I'm self-seeding it. I do want to put this up there for everyone because I work with one of the best technicians, because I happen to not be one. If you're trading today, the red line there, the red circled, the expertly circled red number there, 1337.80, that's my number, on top of Michael Moore of More Analytics number. And he's someone I'd like to have on with you to talk energy. He's the best at technical analysis. But those are some.
Be my ambassador and extend an invite. Have him get a hold of me.
Absolutely. His by the way, his work, $4,000 a month, professionals only, no retail. I'm trying to get him to give me a retail product so we can discuss it more openly on the air. But I would be short below 42 in April. And I will be selling rallies to 42, and I will get probably a sell signal on my momentum style operation below 37. Let's go back to the chart, and obviously, so what do you think? I'd love to come back. We haven't even touched on any of the war stories, and we are worried.
Yeah, I know. We didn't. I know. So next time, so we'll do it. We're going to get. I think I'm going to offer you like a slot, frequent slot, so that people, can. There's some continuity. So after we get off the air, we'll find another date for you right away. And I just want to thank you, Vince. And like it or not, no matter how we started off, you're my trading warrior brother. And I learned from you today. I learned a lot from you today. In fact. Thank you for edifying the whole community, Vince.
Well, thank you, and I love being part of an experience where I get to learn as well as teach. And you've already taught me a valuable lesson: to not be a jackass to someone.
Forgive yourself. We all are. We're all human, and really, everyone. If you want to show that slide one more time with your contact info.
Oh, sure.
And people want your Twitter. Michael Beatty wants your Twitter, so if you could show that. And yes, Barry, there will be a video. We record all of these. It'll be released on Twitter in about 3-4 hours, so you'll see it there. And Vince is going to put his contact info up there again. There it is.
Okay.
So
I do have something, and this is entirely for free. I'm not, there's nothing. This is fun for me. Okay. We do something at 8 a.m. every day called the Gold Fix. And basically we go through some gold and silver numbers. And on occasion, I'll throw some educational pieces out there on options, derivatives, volatility. I am published at the university level discussing energy volatility. And we talk about Apple and market structure. But 8 a.m. is when you'll get something out of me if you're precious metals and oil and FX. But if I'm on at the same time that Dale is, you can always watch Dale because I'll rebroadcast that later on. Okay?
I want people to go where they want to go that serves them and helps build them up to be better traders every day. So that's a nugget right there. So you could catch Vince. And I want to thank our audience from investing.com for joining us today. And thank you, Vince, once again. And may pips rain down on you and your family. And really glad that we met, and we'll be talking again. That's a promise.
And I'll be looking forward to it. And thank you for having me, and thank you for your audience for listening. I'm sorry I didn't get to their questions, but we can come back and talk about whatever you want, whenever you want. It's
okay. And remember, and this is for you too, Vince, and everyone listening. Don't just count your pips, count your blessings. And right. I'll see everyone tomorrow. Good hunting the rest of the day. Thank you again, Vince.
Thank you.
Adios, everyone.